All right. All right, we are live on Facebook. We are live on Clubhouse. Welcome, welcome.
Good morning. Happy New Year, everybody.
Yeah, happy New Year. Awesome. So let's go ahead and get started. For those that are listening in for the first time, my name is Rivera. I'm the team leader for Keller Williams Southeast Los Angeles. And today we're going to be doing a couple things. One, I want to wish you all an incredibly happy New Year's. I know that this New Year's has been a little bit different than most. So I hope that we entered the year with great goals, with health and happiness, and really looking at the blessings that we have in front of us. I want to jump into the market update very, very quickly, because a couple of the other things that I want to cover, besides looking at LA, Orange, Riverside, and San Bernardino, I want to talk a little bit about the forbearance numbers. We saw a rise again. So we're going to talk a little bit about that. And then there's a couple other things that are going to be really important, which one of those is actually Zillow's transition to IDX. And so we're going to talk a little bit about that as well. So a lot to cover, my friends. Let me go ahead. And for those of you that are watching, whether you're on Facebook or you are on live on the Zoom with us, I'm going to go ahead and share my screen. If you are listening in on Clubhouse, I do want to let you know that in about an hour, these slides that we're looking at will be available at realestaterevolution.co. That's .co. So that's definitely going to be another location. If you want to follow along, then you have that resource available to you as well. For those that are on live with me visually, can you guys see the slides? Thumbs up. All right, awesome, and welcome. I see Adriana, Shelly, Ralph, Diana, Jennifer on Clubhouse. I see Adrian. Welcome to the room. So the first thing that I want to go ahead, and I see a hand up. Jennifer, did you have a question? Or is that your thumb? That was your thumbs up, wasn't it? Awesome. Thank you. Okay, awesome. So let's go ahead and start off looking at showings within California, specifically within the past couple of weeks. Now, we always want to inspect what we're expecting when we look at the showing trends. One of the things that we've been monitoring over the last couple of months is when the pandemic first started, we saw quite a big dip in terms of the number of showings that we've had. That, of course, if we look at the trends, that of course recuperated, and then we surpassed our 2019 showing numbers for a number of reasons, right? One of those being we had, and awesome. One of the reasons that we've surpassed those numbers was, one, we had a decrease in interest rates. Right, so that major decrease in interest rates over the past year increased the amount of qualified buyers that were getting into the market, even in the midst of this pandemic. The other thing that we saw happening, quite frequently around, was we had more showing requests that happened throughout the past 12 months or so, not 12 months, but since March or so. Once we had kind of that recovery and the stay-at-home order was lifted, we saw the showings continue to increase. Now, not only was it because we had more buyers that were flooding the market because of those interest rates, the secondary piece that was really important here was the fact that now all of a sudden your buyers were needing to see more properties. Right? They couldn't just go see one, because what do we have? Supply and demand means that we have major competition that's going on. So we've seen those numbers surpass our 2019 numbers. Now, as we start looking at going into this new year, we're kind of ending the week over here. I want you to see this. We saw a major dip here about in November, right? And that was because of what holiday? That's Thanksgiving. Right, so we saw a major dip around the Thanksgiving holiday. We did see a recovery in terms of showing numbers, not quite to where we were. And then we saw another dip around the holidays. So we've seen these dips here for both Christmas, and then as was anticipated, we saw another major dip in showings around this New Year's holiday as well. I want you to just take a look at right down here when we're looking at the numbers from the previous year. There's also a dip, though it wasn't as dramatic. So again, we're seeing a lot more of a dramatic dip because the numbers were so high. We always want to inspect what we're expecting. So we want to continue to monitor this. We should see showings pick up a little bit, but we know that the first quarter always tends to see a little bit of a dip in terms of sales and transactions as well. So what we want to monitor over the next couple of weeks is, as this number goes back up, is it going to return to this kind of, right before the holidays levels, or are we going to see it kind of stabilize a little bit more instead of this consistent rise? So we'll keep a look at that as well as we monitor our showings here. Now let's go ahead and look at our trends. So Los Angeles County pricing trends. Within the past week, our under contract price was $666,000 in Los Angeles County. Sold properties, the average price point within the last week was $675,000, right? And our new inventory. So if you remember, last week we saw a slight dip in price point in Los Angeles County. This week we saw that recovery. In fact, it shot up a little bit. We're seeing the price point for new inventory within the past week in Los Angeles County was $699,000 across the board. So just something to keep an eye on there as we look at those trends. Now, as we look at the trends across the board from the last 12 weeks to the 12 to 24 weeks prior, our under contract inventory has seen a price increase of 0.9%, right? Of 0.9%. Not a major increase, and yet we've seen that's going to account for about a $6,000 difference when we're looking at these past 12 weeks versus the 12 to 24 weeks prior. Sold inventory, right? Sold inventory has seen an increase of 1.8%, which is a little bit less than $12,000 difference, right? So we are seeing that as properties are listed, even if the list price is not increasing so dramatically, we are seeing prices increase a bit more dramatically, where this is in the multiple offer scenarios that are driving properties up, right? And driving price up. And that's where we're kind of seeing the biggest increase. So in that sold inventory, that 1.8% increase accounts for a difference of about $12,000 over the course of the last 3 months in comparison to the quarter prior to that. Now, as we look at new inventory, that's been about a 0.4% increase. That accounts for about $2,500, right? $2,500 of an increase there as well. So we want to monitor this because, again, we had seen price for new inventory go down, and now we've seen that go back up, and that may account for right now here at the end of the year, those last listings that we're getting on the market wanting to take advantage of a higher price point entering into 2021. Now let's look at our new inventory and the inventory trends for Los Angeles County. Now, this is one of the numbers that we've been monitoring very closely. When we first started talking about the inventory, what we've seen is that our under contract, right? Those properties that are going under contract, they've dropped the last 2 weeks, but of course we've been in a holiday. So we'll have a little bit more clarity around what this number is going to look like going into next week. This past week, we have 678 properties that went under contract in Los Angeles County within the past week. For sold inventory, there was 922 properties that sold in Los Angeles County within the past week. That has been decreasing since about December 14th, which is one of the things we tend to look at. And yet, if we're looking at the last 3 months versus the 3 to 6 months prior to that, we've still seen an increase in sold inventory of 1.2% in Los Angeles County. Now, when we look at that, that's not going to be a major increase. That accounts for about 14 properties, right? That accounts for about 14 additional properties per week sold within Los Angeles County. Now, the reason that this is going to be important and the reason that this number going up is significant is because generally in the fourth quarter, we see a dip in sold inventory, which we did not see within this past quarter. We saw it kind of be pretty stable and have a slight increase, which is unusual for fourth quarter trends. What is a little bit more usual for the trends that we see in that fourth quarter is the new inventory. So new inventory on the market, it did recover slightly from Christmas week, right, to this last New Year's week. We had 529 properties hit the market in Los Angeles County as new inventory within the past week. However, we've seen a consistent decrease in new inventory hitting the market since September 28th, 2020, right? Since September 28th, 2020, we can follow this red bar is our new inventory, and we can see specifically there was a little bit more of a bigger dip here at 11/23, which was our Thanksgiving week. And of course, we saw a little bit more of a significant dip here, which was our Christmas week. We saw a slight recovery, but not too much right here for New Year's. Overall, it's a 30.2% decrease over the last 12 weeks in Los Angeles County. That, although we know that a decline in inventory is typical of the fourth quarter, this has been a pretty significant decline in inventory across the board. So we're going to want to continue to monitor this. A couple things that could change this. Of course, we want to see what happens toward the end of this month, right? If we end up seeing these moratoriums extended or if they're going to be lifted, that's going to play a really important role in what inventory we see hitting the market, as well as looking at our absentee owners who are dealing with renters that may not be able to pay the rent, now being put in a position where they're needing to kind of meet the mortgage requirements, right? Depending on if they're in forbearance or not. So that's going to be something we want to keep an eye on as well. Now, looking over here at Orange County pricing trends, right? Orange County pricing trends, we've seen again a little bit of that steady decrease in terms of new inventory price. So we'll take a look at that. Orange County actually saw an increase this past week in properties going under contract in the price point, right? So that median price point for under contract properties within the past week was $817,000. Median sold property price point was $790,000. And for new inventory in Orange County specifically, we had properties listed on the market at $775,000. Right? This is going to be important for us to keep an eye on because, again, we see in the last 12 weeks in comparison to the 12 to 24 weeks prior in Orange County, prices have trended up by 0.9%. So very similar to what we're seeing in Los Angeles County. Sold pricing, again, this is really similar to what we're seeing in Los Angeles County. Sold pricing is up 1.3%. Where we're seeing it fluctuate a little bit different from what we're seeing in Los Angeles County is our new inventory. In Orange County, we are down approximately 1% in price, right? Across the board in the last 3 months compared to the 3 to 6 months prior. What does that account for? That's about an $8,000, a little bit more than $8,000 difference in terms of new inventory that's hitting the market. This is going to be really important. If you are listing property in these counties, you really want to keep an eye on these pricing trends so that you can avoid overpricing property in a market that may not support it, right? Before, we know that in the last decade or so, because prices had continued to basically trend upwards, if you overpriced a property, it wasn't a major issue because the market would catch up. Right. So it wasn't a major issue because the market caught up. Now, where we're seeing that not necessarily be as significant now, we still have a high level of demand. However, if a property is overpriced, you're not going to get the same level of exposure, and you can put your seller into a little bit of a difficult position if they're only getting one potential offer on the property versus having multiples come in on the property. So keep this in mind and keep these trends in mind as you're pricing property in any of these counties. Now let's go ahead and look at the inventory trends. Now here's something that's going to be really interesting. I want you guys to take a look at this. We've seen a dip in the past 3 months in inventory under contract, in sold inventory, and in new inventory in Orange County. This is not the same in some of our other counties. Why? Part of it is because Orange County has a higher price point, right? And when we start looking into a higher price point, what happens? Well, we see people that may not be able to qualify for those higher loans, right? If we start getting into jumbo loan territory, then that changes things a little bit as well in terms of who's going to be qualified. We see a lot of times certain areas in Orange County are going to be a little bit different in terms of, people buying second homes or kind of upsizing or getting a little bit more into that luxury market. And so there's a lot of people that are not necessarily buying a second property right now as a vacation home or as just an additional home. Where we see that increase is people buying investment property, right? That's a little bit different. And we're usually going to see that in a little bit of a lower price point area than in Orange County, which is our highest price point county of the 4 that we're going over today. So just looking at this inventory, under contract, right? Under contract properties, we saw another dip. We've seen a dip since November 30th. We kind of saw that continuous dip in under contract inventory. There was only 346 properties that went under contract in Orange County within the past week. 600, right? 600 properties sold in Orange County within the past week. And only 267 homes were listed in Orange County within the last week. Overall, from a trend perspective, that's a 22.7% decrease in under contract inventory, a 7.7% decrease in sold inventory, and a 39.2% decrease in new inventory that's hitting the market. That's a really significant decrease across the board for Orange County specifically. Again, this is going to be a little bit more in line with trends that we tend to see within the 4th quarter. So we want to see how this continues in over the next 3 months or so. This is going to be where we can really see, is this just mirroring what we usually see? Or is there's something else going on here? We're seeing decreases in inventory across the board. So that, of course, is going to play into some of what we're seeing in price point and some of the other things that we're going to see as well. But it's just really important to keep in mind that Orange County is a little bit of our anomaly. And again, we always want to inspect what we expect. That has a lot to do with it being a higher price point market. So we want to keep that in mind as well. Now, as we start looking at Riverside County, right, as we look at Riverside County, week 1 under this last week and under contract pricing, 435,000. Sold inventory hit at about 455,000 and new inventory at about 430. Again, so here we see the flip side of what we saw in Orange County. We're seeing pricing up across the board. So under contract is up across the board about 2.8%. This is a little bit higher than what we're seeing in Los Angeles County in terms of pricing, right? That's about a $12,000 difference, right? $12,000 difference within the past 3 months versus the 3 to 6 months prior, right? 3.8% increase in the pricing around properties that have sold, and a 1% increase in new inventory that's hitting the market as well. So just a couple things to keep in mind here. That difference, that 3.8% difference in sold pricing, what that means is that homes are selling on average for $16,000 more in the past 3 months than they did 3 to 6 months ago, right? They are being listed for a little less than $4,500 more than they were 3 to 6 months ago. So that's what that looks like when we're looking at that trend. Now looking at the inventory, again, we're seeing major dips all across the board here, right? All across the board here. There was only 314 properties that went under contract in the past week in Riverside. Only 532 properties that sold. That actually increased from the prior week, right? However, if we look at the trend across the board, we're still seeing a 6.8% decrease in the past 3 months compared to the 3 to 6 months prior. And new inventory, only 278 homes were listed in Riverside County within the last week. Now, what we want to look at here is the significance of, again, the spread here in new inventory across the board has been the highest. Decreases that we're seeing is in the new inventory that's coming on the market as we came out ending the year, right? As we came out ending the year, that's a 30.6% difference if we look at the third quarter versus the fourth quarter. Pretty significant there. That counts for about 240 unit change every week, right? Every week. So that's a pretty big change across the board as well. Now let's go ahead and look at our San Bernardino County. San Bernardino, again, like Orange County and San Bernardino, we're seeing, sorry, let me go to, here we go. Oh, I'm missing there we go. So San Bernardino County as well, and give me a second here. I will have to get you guys the pricing trends on San Bernardino County, but let's go ahead and look at the inventory trends here as well. So when we look at inventory trends, again, we're seeing the same happening across the board in terms of our inventory trends. We had in San Bernardino County, 329 properties under contract, 415 properties sold, and 264 new properties that hit the market in San Bernardino County within the past week. So some pretty significant dips here as well. Under contract, that's a 14.8% decrease. Now, what I want to remind you is San Bernardino is a little bit smaller than, let's say, Los Angeles County. So what might look like smaller numbers across the board in terms of changes is going to account for a higher percentage drop, right? Because we're looking at a smaller, kind of a smaller sample size. So in terms of the change, a 14.8% decrease accounts for about 85 unit difference every single month. In terms of our sold inventory, that's going to account for a 7.3% decrease. That's about 42 properties every single week. And then new inventory, that's about 185 properties difference every single week, with new inventory being dropping 26.8%. So a couple of things that are going to be really interesting here for us to think about. This is us looking at the past quarter, right? We're coming at the end of, we just came out of the end of the year. We just celebrated New Year's. And so what's really important for us to keep in mind here is that we saw a couple of trends that were really interesting in the fourth quarter that are unusual. One of those has been that the amount of home sales did not see a decrease, right? While new inventory saw a decrease, which is generally expected as we go into the fourth and first quarter of the year, because of seasonality, we did not see that same level of decrease in terms of homes that sold. This is for a couple reasons. We've had a lot of pent-up demand that got released because of the pandemic. So generally the second quarter is one of the highest productivity quarters for real estate. And of course, because we were in a full lockdown during that time, there was a lot of pent-up demand that got released in the third and fourth quarters. Interest rates have also stayed low, right? Interest rates have also stayed very, very low, which gives a lot more people a greater amount of buying power. And because there's a lot of additional buyers that got into the market and we've had limited showings, it's caused a really big increase in the demand that we have for properties and how much people are willing to compete. And at the same time, inventory has continued to decrease. So those trends are really important as we're talking with our buyers. If you have a buyer that is having a really difficult time because let's say they have some type of specialized loan, right? It might be worth looking at properties that maybe have been sitting on the market a little bit longer, right? So that they have an opportunity to compete if they're not able to compete in the price point that they're currently at. The other thing that's going to be really important is if your client is pre-approved for 450, we're not looking at properties that are listed at 450, right? We have to give them the opportunity to be able to compete overall. We have to give them the opportunity to be able to compete in a multiple offer scenario. The other thing that's going to be really important here is we want to make sure that we are monitoring our appraisals and that we are still vetting our appraisers, right? As you are going under contract, make sure whether you are on the buyer side or the listing side, an appraisal that comes back low can end a deal no matter what side you're on, right? So we want to make sure that we are vetting the appraisers to make sure that they have experience in the market that they're going to be appraising. If the property has anything that's kind of specialized around it, you want to make sure that you provide that information to the appraiser, any investments that were done into the property, any improvements. You want to make sure that you're providing that information, but you also want to make sure that if there's specialized items like the property is a flip or the property has an accessory dwelling unit, that the appraiser that you are working with has experience with that type of property, or you do have the right to request a different appraiser. And that could be the difference when we're pricing that property and getting the appraisal on an appraisal coming in low or not, right? Which is going to be really important. The other thing, I know we are going over a little bit on time this morning, but the other thing that I wanted to make sure to share, the forbearance plan increases. As of January 1st, right? As of January 1st, the US has seen its third consecutive week of forbearance plan increases, right? We saw that forbearances increased by 15,000 from the prior week, right? And what it's pushed the number of active forbearance plans to its highest level since early November, right? We saw FHA and VA forbearances also increase by about 11,000. This is going to be really important for us to keep an eye on. We've been talking about the mortgage forbearances and what this means. And right now, guys, as of right now, until something changes, the moratoriums on eviction and foreclosure are going to be lifted at the end of this month. All right, I'm going to say that again. As of right now, unless something changes, the moratoriums here in California for eviction and foreclosure are going to be lifted at the end of this month. If your clients are in any type of a delinquency, right? So I really want to put this in perspective for you guys. Can they request an extension if they're on a forbearance? Yes. Okay, they can. In most scenarios, they can request an extension. However, mortgage forbearances are designed to last a year at the longest, right? Mortgage forbearances are designed to last a year at the longest. Now, if we recall what happened, the pandemic started in March. A lot of people went into forbearance in March, which means the clock is ticking down. You also have an estimated, and this is as of what, a month ago, an estimated over 14 billion in the United States in unpaid rents. 14 billion in unpaid rents. That means that a landlord who maybe has had their own foreclosure moratorium, right? They have been subjected to the eviction moratorium. So they have not been able to evict on clients that are tenants that are not paying rent. And in reality, for most mom and pop investors that count on the rents in order to pay their mortgage, there's a bit of a trickle effect, right? tenants aren't paying the rent, landlord cannot pay the mortgage and are not allowed to evict the tenants. Now you have all of this unpaid rent that is going to be at the burden of the landlord to connect. Now, might there be some type of mortgage forgiveness? Might there be some type of rent forgiveness that comes down the pipeline? Maybe, right? Maybe. I'm not going to say there is. I'm not going to say there isn't, because that is a decision that needs to be made at the federal and the state level on if there's going to be any type of new things that are kind of offered. But as of right now, the problem that people have are this: tenants are worried about what happens next. Am I going to get evicted once this moratorium is lifted, right? Your landlords are worried about, if my tenants can't pay rent, and eviction is not easy either, right? An eviction is not necessarily going to be the best solution for them, because that takes months sometimes, right? And in reality, a lot of these landlords, it's not that they want to evict, right? You realize, so I'll give you an example. Even the portfolio that my family has, we know that there are tenants that at least about 25% of the tenants that are not paying rent because they're unable to. And yet, if it's been a great tenant that's been in a property for 30 some years, right, and have been stable, and now they're subject to, you know, the pandemic and the economic situation that they're in, there's no landlord, I mean, most landlords don't want to evict that person because of economic hardship that occurs right now, right? And yet, unfortunately, you're going to have some landlords that are either, well, two types, right? Those that are in a difficult financial situation themselves, and they may have no other options if they aren't able to collect on some of this missed rent that they've had, or unfortunately, some of the more institutional landlords that are really a little bit just more concerned about the cash flow, right? But the cash flow, because it is also a business for them. So you have that trickle down effect of now these landlords that may be in a position, if these moratoriums are lifted, that these different foreclosure proceedings can be started against them as well. What I would be doing right now, a couple of things, right? If you haven't made your New Year's calls, it's okay. Right now, it's still a good time to do that, right? As we're at the beginning of the year, that conversation is still, hey, I wanted to give you a call. I wanted to wish you, you know, a happy new year. And one of the things that has been very concerning for me across the board with people that I've been talking with, I want to make sure you have this information that as of right now, the moratorium on eviction and foreclosure is being lifted at the end of this month. Do you or anybody that you know need any additional information on this? I want to be a resource to you. That's the call, right? That's the call right now. Is we are the resource, our fiduciary duty for our clients, right? Well, sometimes it's to help them sell their home. Sometimes it's to inform them about what's going on in real estate. You have to be the local economist, the local expert of choice for your clients. You want to make sure that you're giving them that information. I would make sure that you are calling everyone that you know right now, right? Everyone that you know, and you're having that conversation with them, because a couple things are going to happen. You're going to identify who in your sphere of influence or who in your network is struggling themselves and maybe needs additional information and needs to understand what their options are. And some of those options might be repayment, right? Some of those options might be, figuring out if they're able to refinance or do some type of loan modification, which we are seeing those loan modifications start to hit. And for some of them, it might be to sell. Jennifer, I see your hand raised. You want to come off mute? Go ahead, Jen.
Hey, Monica, good morning. Happy Tuesday, everybody. So I know that we don't have a magic ball to determine what's going to happen at the end of the month, but what's the talk around town? Like, what government branch should we be monitoring to see what our legislators leaning towards doing when that date, as we get closer to that date?
Yeah, definitely. So honestly, it's going to be, we want to monitor, of course, what's happening federally, but that's going to be kind of at larger scale. Here's the thing though, is federally last month, they made the extension to January 31st. That happened last month. That didn't impact us in California because our state government had already made the extension of the moratoriums until January 31st. right? So California actually had, I guess you could call that leniency or something that's a little bit more in line with helping the landlords and helping the tenants. We had a longer extension period in California than we did at the federal level. That changed in December, right? In December, that extension was made at the federal level. So there's a couple things here. Is in reality, we know that was a decision that California made a while back. We've kind of been going through that over the past couple months, and the feds made it very quickly, right? So our chances that we could have a bill or some type of proposal that gets pushed across within the next 3 weeks, yes, that is definitely a potential outcome. We also want to make sure that we're monitoring what the financial institutions are doing in particular, especially looking at, for example, Freddie Mac, Fannie Mae, right? Some of the more the government institutions, financial institutions for the real estate industry, because they're also looking at how does this impact if all of a sudden you have a ton of people losing their home, running foreclosures, running all of these different things. It's not a cheap process, right? And if we remember, I mean, for those of us that were watching the industry and seeing the industry in following, starting in 2005, which a lot of people talk about the recession happening in 2007, 2008, but we started seeing the first indicators with the GDP drop in 2005, right? We saw a lot of properties that went vacant. There was ghost towns. I highly recommend for those of you on this call that maybe didn't have a chance to be in that market, if you have not seen the movie, The Big Short, great movie, and just a really great review of kind of what happened during that time. This is different in a lot of ways. There's a lot more people that have equity. So I think as a financial institution, we know that there's two universal laws. The bank and the IRS never lose, and the bank and the IRS always win, right? So they're also going to look at what is going to be lucrative and make the most sense for them. And all of a sudden having an influx of property might not make the most sense for them. They are probably going to be looking at different modification options. I know with Fannie Mae and Freddie Mac especially, right? Loan modifications is probably going to be a really big part of that. But for the time being, honestly, Jen, we just need to monitor what the feds are doing, and then we need to monitor what's happening with local government. And then, of course, with the financial institutions in particular, I'd be looking at Freddie Mac and Fannie Mae. Go ahead, Jen.
One other thing that I wanted to maybe request that you share with everybody, and this is going back to the trends. So if you look at the inventory trends for every county, I mean, it's pretty much across the board. You see that the under contract the sold is always higher than the new inventory. So if you can kind of just remind everybody what that means, because that's just a basically foretelling what the future is going to be like, right?
Yeah, that's huge, right? So to put that in perspective, I want to mention seasonality, right? Is the first thing that I want to mention. What seasonality is in real estate, we know that there tends to be trends that are based on the seasons that are pretty consistent across the board. One of those trends is that usually in a more urban area like ours, so this does not apply to areas that are like vacation homes and things like that, right? So if you were looking at an area like Big Bear, if you were looking at a different area, the seasonality is actually reversed in those areas, right? But regular seasonality in an urban area like the counties that we're a part of, Los Angeles County, Orange County, Riverside County, San Bernardino County, and what we're looking at, the second and the third quarter tend to see an uptick in the number of sales. It tends to see an uptick in the number of units that are hitting the market. It tends to just see a rise overall in real estate, right? Under contract, sold, new inventory that comes onto the market rises in second and third quarter. We tend to see a dip in the fourth quarter and the first quarter of the year. So that's our October, November, December, right? Fourth quarter of the year. And then January, February, March, right? First quarter of the year, which tends to see the biggest dip. Why? is because we know that real estate is a cycle. So you can meet somebody today, and let's say you were to get your offer accepted today, and now all of a sudden in 30 days, right, that's when inventory closes. Now, if we saw showings trend down in December, where do those sales happen? Well, those sales happen in January and February, right? Anything we open escrow on now is what happens. It's closing a month to 2 months, a month to 45 days from now, whatever that looks like, because that's the way that the real estate cycle works. What has been interesting that we've been looking at within the fourth quarter. So because of the pandemic, we saw a major decrease across the board in under contract, in sold units, and in new inventory in the second quarter of the year, right? Basically, seasonality was thrown out the window. The pandemic shut everything down, major decrease across the board. That changed in the third quarter. We saw recovery, and towards the end of the second quarter, we saw recovery. But not only did we see recovery, we saw pent-up demand. Now, looking at the fourth quarter, when we see that sold inventory, sold units are up in the fourth quarter, which usually sees a decrease, and yet inventory is down, what does that mean for us? It means that one, the trend is a little bit different here, because we're seeing sold inventory up, likely releasing a lot of this pent-up demand, a lot of the activity that happened in the third quarter. We're seeing that coming to fruition here in the fourth quarter. But the secondary part of that is new inventory continuing to decrease. We still, that's supply and demand, guys, right? Is we still have a high demand for people wanting to close on properties, and yet the supply is so low, which does a couple things. It drives price, right? It drives price. And what's the biggest question that everybody's asking? All your buyers are saying what? They're like, well, should I wait till next year? Guess what? It's 2021 now, right? They're asking, should I wait till next year? Should I see if prices go down? Here's the thing. The only way that we see a major price correction in the market, the only way that we see a major price correction in the market is if so much inventory floods the market that it can counter the demand, right? It can counter the demand, that there's so much supply that all of a sudden the supply is higher than demand. But with the number of sales that are going on right now, we have yet to see if that's going to be likely in California. Right now, as I don't have a crystal ball, I don't want to predict the future on it. I could anticipate that at some point we have a price correction. I don't anticipate, and I'm going to knock on wood, but I don't anticipate that we're going to see the bottom fall out the way we did in 2007, right? We're not going to see properties come crashing down like that, because why did that happen? Well, that's because there was a lot of properties that were underwater. So there was a lot of people that were just kind of, going short sale, releasing the property. The banks were negotiating. Is that going to happen this time around? I mean, we'll see some short sales, sure, but not as many as we did. Did you have another comment or question, Jen?
No, that's it. I'll lower my hand.
Awesome. So I know we went over by 20 minutes today, guys. A lot of information. I'm going to post that forbearance article for you guys. A couple things that I want to go ahead and mention that are going to be on the calendar for this month that are going to be really important. I know I see a couple of you on the call. We are going to be, so I am working very closely with my dear friend. A lot of you guys know her, Sophia Chacon, who works out of and owns the Keller Williams, the Lake, and Keller Williams College Park. We're going to be collaborating with them on a couple different events, including for our ladies on the call, our Deals in Hills Mastermind. Diana, I see you on the call. We're going to have a great power couples mastermind, specifically for those that are working as husband and wife. So I know we have a couple of those in the office, so that's going to be happening as well. We're going to be having, so some of you guys may remember Steve Ryder, right? Steve Ryder is absolutely phenomenal. He was the guy, if you recall, he did his business planning clinic, and he mentioned how he had his arm in a cast because he fell off his yacht. If you guys remember, it's a pretty funny story. Phenomenal speaker. So there's going to be a couple series that we're collaborating with them on. One of them is he's doing his 100 Days Foundation course, which is going to be the first one. And then as we enter, not starting in February, probably starting in March, but he's going to do his Path to 10 Million, right? Which is going to be the follow-up course that he's doing. So that's going to be something that we're collaborating with them on as well. So there's a lot of stuff on the calendar. We're going to have a listing presentation clinic. And then I know guys, you know, while short sales are not going to be the biggest piece this year, right? Because there's not quite as many of them because so many people have equity, it's still important to have some education around them. So there is going to be a small short sale class later this month as well, so that you guys have an understanding of what they are when they do come up, and then also have a little bit more clarity on how to identify what is going to go that route and what you want to negotiate on for a standard sale. So there's going to be a lot of stuff on the calendar. We're going to keep you posted on it. I'm going to be posting some certain ones that go out in advance so that you can register for it. We also have Linda McKissick this month, right? Linda McKissick this month. I wanted to tell you guys in advance. She's either next Friday or 2 Fridays from now. For those of you that don't know Linda McKissick is the queen of cash flow. When I say the queen of cash flow, Linda McKissick not only runs a highly successful real estate team and is involved in multiple market centers. She owns over 400 properties, right? Over 400 doors. And she cash flows over $1 million between her and Jim McKissick, her husband, over $1 million just in profit share every year. Right. And that's looking at investment properties, looking at the real estate business. So she is an absolute powerhouse. She runs a phenomenal real estate podcast. She's a major influencer in the real estate community. So we're really excited to have her this month as well. So there's going to be a lot of stuff that's on the calendar. The other thing I wanted to do, I wanted to acknowledge Ralph Robles. Thank you so much for putting me on the Clubhouse app. If you guys have not jumped on the Clubhouse app yet, I highly, highly recommend it. I definitely, there's so much amazing knowledge that's being shared. It's a new social network that is a voice-only platform, right? It's a voice-only platform. So it's going to allow you the opportunity to kind of listen in on some pretty amazing real estate conversations. I've had a chance to listen to some great conversations with Grant Cardone, right? Gary Vaynerchuk, with the Lab Code agents. We're on a session this yesterday evening. So there's a lot of great knowledge that's occurring in there. It's a really great platform. We're going to be, I'm talking with a couple of different team leaders that are starting to look at what are going to be the implications of this particular app as a social network to connect with your community and just provide value across the board. Because what happens, people are missing having a conversation, right? They miss having conversations. And so it's a really great opportunity to listen live. Nothing on Clubhouse is recorded, which means if you're not there for the conversation, right, it's gone. So it's a really cool new social network. Definitely check it out. And we'll be sharing a bit more on it as well. But with that, I hope you guys have an absolutely phenomenal rest of your day. I know we got another class. You might want to get your coffee before contracts in 5 minutes. And thank you guys for bearing with me, going way over time today, but definitely a lot of information to cover as we come into the new year. With that, I hope you guys have an absolutely phenomenal rest of your day, and I will see you soon.
Bye.
Bye, everyone.